Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And many of you know me as Mr. Valuation, and as it relates to today's video, that's really very, very important because what I'm going to be talking about here is the relative valuation of the S&P 500. But I'm going to look at it two different ways. I'm going to first of all look at the market in general, which is what most everybody's talking about. You know, as I'll show you here in a moment, the financial press, the media, YouTube channels on finance, everybody's talking about how overvalued the market is. But I'm also going to look at the market from a micro point of view. I'm going to look at individual stocks in the market and try to illustrate and show you clearly that even though the market in general may be overvalued, there's a lot of good value to be found. But I'll be illustrating that and show you how I find those values and how I look at them. Okay, so to start with, I think the first thing we want to do here is start by letting me, I prepared a little slideshow for you, and I want to kind of give you some perspective on what this video is about. One of the videos I recently watched was a video on interviewing Charlie Munger, and he talked about the coming lost decade. And he mentioned that he felt that way for a lot of reasons, inflation, taxation, but primarily because the S&P is so significantly overvalued relative to historical norms and relative to fundamental value. And I think that is true if you're looking at the entire market as one. But keep in mind, I'm a believer, and I've said it so many times, and many of you who've watched my videos and followed my work over the years know that I believe that it is a market of stocks and not a stock market. So, you know, the devil's in the details, so to speak, but so are the angels. There are a lot of good value stocks, and I think you're going to be surprised when I get into the details of this, just how many high quality stocks you can buy even in today's extremely inflated market. But I also want to talk about why I decided to do this video. I've had several comments. I've just highlighted three here from viewers of my channel on a couple of different videos that I did. One was by Jonathan Montgomery 17 hours ago, and Jonathan quoted, made a comment. He said, "It's depressing. Hard to be a young person getting started investing today. Everything is so overpriced." Well, I'm going to try to give Jonathan some solace here and point out that not everything is overpriced. In fact, you'll be surprised how many things are not. And then RJW a couple days ago said, "Overvalued they are." Again, using the word they in the aggregate, but what's the alternative? Selling and going into cash? Sure, it will end in tears, but where do you hide? Well, you don't have to hide. You can find good investments in this market, and I intend to show you that with this video. And then a few hours ago, Strong Force 79, another viewer said, "With everything so overvalued, how is a middle-aged working dad supposed to approach this type of market? Everything worth anything looks so out of reach." Well, I'm going to try to convince you that's not totally true, Strong Force. And he goes on to talk about microtransactions, but can you build any kind of wealth with microtransactions? Well, what I'm planning to demonstrate here is that there's plenty of real high quality stocks, growth stocks, dividend growth stocks, etc., that you can build a portfolio with today, more than you need, even though the market's overvalued, because in every market, whether it's bull or bear, and I've said this so many times, there will always be overvalued, undervalued, and fairly valued stocks to be had, no matter what the market is. In an overvalued market, admittedly, like we have today, it's harder to find good value. In an undervalued market, like we had coming out of, January, February of 2009, coming out of the Great Recession, almost everything was cheap, but so obviously it's easier in a bear market to find value, but I'm going to really try to clearly demonstrate there's a lot of value even today in this overheated market. And a lot of it comes to understanding the makeup of the market. The S&P 500 is comprised of something like 505 or 6 stocks. I forget the exact number. And the bottom line is it's a weighted index, okay? So if you look at just the top 5 stocks in the index, you've got Apple at 5.7% of the total, Microsoft at 5.3%, Amazon at 3.9%, Facebook at 2.1%, and then Google Class A at 1.8%. Now, if I go to the next 5, the next 10, we got the second alphabet Class C at 1.8. We have Tesla at 1.5. Berkshire Hathaway at 1.5, JP Morgan at 1.4, and Johnson & Johnson at 1.3. So to kind of recap this, the top 5 equal 18.8% of the total. Almost 20% of the entire market is found in these top 5 stocks. The next 5 make up another 7.5%. So when you look at the top 10 S&P 500 stocks, they equal 26% of the total. So that's something very, very important to be considering when you're evaluating the stock market, etc. So, the question is, well, how do you find value in this market? Well, I've got a slide here. This was a Ben Graham slide where he had some statistical requirements. He said, investors should look for companies of adequate size. Most S&P 500 stocks meet that. They should have a sufficiently strong financial condition. You do that through, research and due diligence. He likes stocks that continue dividends for at least the past 20 years. I even go further and like stocks that, if I'm looking at dividend stocks, that have increased the dividend for at least the past 20 years. And he doesn't want to see any earnings deficit, so he's looking for a kind of stock. But then, he talks about 10-year growth of at least 1/3 in earnings per share. He wants them growing by 33% over 10 years. And then the price of the stock more than 1.5 times net asset value, which, was very important in his day, not so much anymore. But number 7 is the one that I want to really focus your attention on. In several places, and even in some of his books like The Intelligent Investor and so on, he made the statement that he doesn't believe you should ever pay more than 15 times, in this particular quote, average earnings of the past 3 years. Now, other places he's talked about 16 times earnings. The point is, a 15 PE ratio is fair value. And for me, and I've talked about this so many times, there are reasons that Ben, I think, believed that, and reasons that I believe that. Number one is the average rate of return to stocks over the past 200 years is between 6 and 8%. And those numbers change depending on what time frame you're looking at, by the way. But that's a good long-term average. Also, if you invert the PE ratio and look at the EP, or the earnings yield, a 15 PE ratio equals a 6.5 to 7% earnings yield. I talked about this so many times. The point being is that's about normal, what you could expect for stocks. So if I'm investing in common stocks, or any common stock, I see myself as a shareholder owner of the company. I want to invest in that business because I admire the business. I want to own it for the long term, but I also want to make sure that I'm getting value for my money. Now, if I have the discipline to only pay a PE ratio of 15 or lower, then I'm getting an earnings yield of 6.5% to 7% or higher. Okay, and that becomes kind of an acid test for me. But let's start by looking at the S&P in general first. Number one is, if you look at coming into the Great Recession of 2001, the 3 or 4 years prior to this were considered the irrational exuberant period. Here you can see the PE of the S&P peaked at about 25.6. Today, the blended PE of the market's 28.5, or even higher than what we saw here. Now, if I measure, this was referred to as the lost decade, and I'll get pretty close here. If I measure the market from, I got February of 2001 to August of 2010 here, roughly a 10-year period here, you had a 0 rate of return over that 10 years. But you can attribute most of that, in fact, I attribute all of it to the fact that, first of all, we did have 2 recessions in that time frame, but it was the high valuation we had coming into the recession of 2000 and then the recession of 2008, 2009. Those were 2001 recession. These were, really troubled times. But if you looked at the market, you did have a lost decade. But now, if you would have bought stocks when they were more reasonably priced, by the way, even within this decade, there were times where you could have made 13, 14% a year. All right, I want to be clear. Valuation is the culprit here. Okay, today we've got this blended PE of 28, which is even higher than the 25 we had here. And if I'm looking at the S&P 500 going forward, the long-term growth rate is expected to be about 8.5%. I consider that to be very, very aggressive. So I'm going to go into the custom calculator here, and I can only go out 5 years on this. But if the S&P did grow at 8.5% and the PE went back to 15, that normal valuation that I talked about a few moments ago, we'd make 3.3% in the market. If it traded at its 16 to 17 normal PE, it'd be 5%, maybe even at an 18 PE, 6%. Okay, now if I then alter that and I go down and I put the normal 6% growth rate of the S&P 500 into the graph, and draw that to where now I've got a 6% growth rate, those numbers get even lower. At a 15 PE, I'd make 0.5% a year. At an 18, I'd make 3.4, and at a 16.5 PE, I'd make 2.01. I'm just using my calculator tool here to give me is. These aren't supposed to be precise. These are just, what would I expect? I expect to make anywhere from nothing to maybe, 2 or 3% a year over the next 5 years and beyond, because of the high valuation of the market. That's the only reason I'm making that statement. But on the basis that it's a market of stocks, not a stock market, let's go ahead and look at how I would screen with the S&P 500. Now, for premium shareholders of Fast Graphs, the first thing I do, now I have a very excellent screening tool, and the new version of Fast Graphs, the screening tool is going to just, as a dear friend of mine used to say, knock your hat in the crick. It's really going to be comprehensive. But I hardly don't even bother using our screening tool. I simply go into our preloaded portfolios, and we have 14 preloaded portfolios for premium subscribers to Fast Graphs. One of those is the S&P 500, and we're showing 505 stocks. So if I click this review button, I go into the portfolio review of the S&P 500, and I can organize this view in several different ways to help me kind of very quickly and easily go through valuation. The first thing I can do, I got the PE and the earnings yield. Now, I've also segmented this down. You can look at the whole index at one fell swoop, or you can look at it 10 stocks at a time. I've marked it to 10 stocks at a time because I want you to see some things here. I want you to get a feeling of what the overall market looks like. Yes, the general market is overvalued. It's very top weighted, and most of those stocks in that top 10 are excessively overvalued. Microsoft, Apple, and et cetera. But having said that, there's also a lot of stocks that aren't. Now, the first thing I did this by PE, lowest to highest, and I did it by earnings yield, highest to lowest. It's the inverse of the PE. But here's the point. These first 10 stocks have 0 PE ratios. Well, how can that be? Well, the answer is very, very simple. If I look at these companies, I'll just pick one here. I'll pick Conoco, Phillips for you. If I look at one of these individual stocks based on, the fact that it has no PE ratio, I know that there's a problem with the stock. And in the case of Conoco Phillips, it has negative earnings. So, what I'm really trying to say here is I'm going to exclude all of these stocks. So out of the 500 stocks, my first 10 have no PE. I go to my second 10, once again, I get no PE. And again, I can look at stocks like, just picking stocks here, Royal Caribbean. We all know what happened to the cruise line industry and how the cruise lines industry, had to shut their doors and still have their doors shut. So once again, I'm looking at a stock that has no earnings right now. Okay, so there's no PE ratio. There's no meaningful number for a PE ratio. So now I'm going to go into my third tranche of 10. So I've looked at 30 of the 500 stocks now, and I still get a 0 PE ratio. Okay, so all of these stocks have some kind of a problem. And, I've covered some of these in the past. I covered the casinos and gaming stocks here in a recent video, and it showed where they had negative earnings, etc. But now I'm going to go into my 40th, my 31st through 40th group. And now all of a sudden, we start to see some PE ratios show up. I've had several of you ask me to look at Viatris, which is the new Mylan Labs that is just, joined forces. It's going to be a generic drug manufacturer like it always has. It's merged with Upjohn. And, the idea here is that they're going to be doing generic drugs, but this stock trades at a PE of 3. It has an earnings yield of 29.94, which is extraordinary. But it also has problems with their EpiPen as a generic. But by blending the two companies together, this company may have a future. They're expected to initiate a dividend. One thing I want to point out, if I look at this stock and look at operating cash flow, earnings have been very, very weak. They've had several problems. The EpiPen fiasco, drug competition itself, generic drugs are under a lot of pressure, but their cash flows under this new entity are expected to increase dramatically. So this could be a great bargain, but it doesn't meet all of Ben Graham's criteria I talked about before. It does have periods of time where it had negative earnings growth, not negative earnings, but negative earnings growth. But anyway, it's a company that you can look at today that's extremely inexpensive. But then as I get down the line, I've written about Unum, and I've shown you names like Allstate and Prudential and Biogen in the past. But these are stocks that have PE ratios under 10 in this group. Now, I've thrown away the first 2.5 or 2.8 group here. So I've got 10 stocks. I'm starting with in the fourth section here that have PE ratios and earnings yield above my 6.5% to 7%. And I've got some that have really exceptional earnings yields here. So that's 10, we'll call it. I'm actually missing a couple, but we'll call it 10. So I go to my next group, I've now got 10 more where I've got very high earnings yields. And I've written about many of these stocks in the past. I've talked about AT&T, I've written about AbbVie, Bristol Myers is one of my favorites, Cardinal Health, Aflac. All of these stocks have very attractive valuations right now. You can look, I know by looking at these valuations and these earnings yields that I'm going to be able to see stocks here when I decide to examine them deeper and get further into the equation that have very attractive values. I was also recently asked to talk about Viacomcbs. And here's a stock that, market way overreacted to some issues. Then the stock rallied unbelievably and now it's fallen again. But keep in mind, this stock is not expected to grow very fast. It might even shrink. It's expected to have negative earnings growth going forward. So that's something else that you would want to take into consideration. Virtually no growth expected over the long run. So that's another issue. But then on the other hand, I can look at, names like Pulte Homes, which I showed, and I can look at names like Hewlett Packard, Cardinal Health, Aflac, and see stocks that are very, very attractive. Now, Aflac is a financial, and the financials have suffered with chronically low valuations since the Great Recession. If I look at Aflac on a long-term basis, you can see that coming into the Great Recession of '08, this stock traded at 20 PEs. It wasn't uncommon to see it. The orange line here is a 15 PE. But I do want you to notice the blue line is below that, because if I drop this down to, like, say, a 12-year graph, all of a sudden I look at this stock and I see that the company is trading at a 10 multiple for the last several years since we've been coming out of the Great Recession. So I can base that on the 10 multiple, but I've got a very good earnings yield. I could have a logical expectation for this stock to go back to a 15 PE, but I don't necessarily need to do that. If I'm looking at forecasting graphs and looking at a normal 10-ish multiple, I've got a stock that can give me 6 or 7% returns. If I go to 15 PE ratio, which I believe it should do, I got 25 to 30% rates of return or even higher. So the bottom line is there are several stocks in this second group. I'm going to go now to the next group here, and I've got really terrific stocks here. I've got PEs under 15. I've got earnings yield over 6.5 to 7%. And if I go look at any of these companies, I'll just pick McKesson here, which is healthcare. If I look at these stocks, just by going through this search, using my portfolios as my screening tool, I can see very, very low valuation. So it is a market of stocks, not a stock market. Some of the first stocks I showed you have horrible records. They're not the same as this. McKesson has a very excellent record. It got caught up in all the healthcare, issues that have been going on here recently. The stock has become very inexpensive, but it's now beginning to looks like at least is beginning to revert to the mean. Keep in mind, this used to commonly be a 15 to 20 times earnings stock, so I see no reason for it not going there. I go into my seventh group at 10, and once again, I still have PEs below 15. I've got earnings yield of 7 or 8%. These are all higher than my 6.5 to 7. I did have a subscriber ask me about DH Horton, because I don't think I included it when I just covered home builder. I covered Pulte and I think NVR, but DH Horton is another interesting one. And here you've got a low PE ratio, but you've also got expectations of pretty high growth going forward. So here again, another example of a stock that you could generate very strong rates of return on. It has very little debt. It's BBB rated. It is a market of stocks, not a stock market. There are plenty of good stocks out there, and I'm just using a simple screen. I'm going through the S&P 500, and I'm looking at it in groups of 10, and I'm looking at it in order of lowest PEs to highest, and highest earnings yields to lowest. I go to my eighth group, which now I have 60. I'm into my 60 stocks. I've still got PEs below 15. I've got earnings yields well above 6.5 to 7%. I've got very high quality stocks, like I've got Merck here, the pharmaceutical. The big pharmaceuticals did kind of go through a decade or so of kind of poor results, but Bristol Myers, Merck, Pfizer, these stocks are really starting to find their mojo again, and they're starting to grow. You can buy them at very attractive valuations. Merck, I think, is extremely cheap with a 12 PE. It's AA rated, only 45% in debt, and it's got an opportunity to generate, better than double-digit rates of return over the next 3 to 5 years. It's a market of stocks, not a stock market, ladies and gentlemen. So I keep going on. I go now to my 9th group of 10. Remember, I threw away 2, so I'm into my 70th, stock here out of the S&P 500. I still have PEs below 15. I've got some really exciting looking companies here. I've got high quality names like Cigna, Citigroup, Molson Brewery, State Street, Universal Health Services, another healthcare stock, Western Union, Intel. I do even have some old tech in here that have, good valuations. These stocks are trading at very low values. They may not be growing very fast, but they make up for it in the fact that their valuations are low. And look how Intel has really rallied off of its real lows when it got, here you had incredible margins of safety. So you've got a decent looking stock here. I would, worry about this, but I'd be figuring out what's going on there. If I'm looking at long-term growth, expected to be 4 or 5%. But the point is, there are names to be found here. There are stocks that you can research and look into. And there's even utility stocks that give you good valuations. I go into my 10th group here now. I'm still below a PE ratio of 15. I can just capriciously look at any of these stocks and know that I'm going to see valuations that look reasonably attractive. Now, I've still got a lot of work to do. I don't stop there. I'm going to dig into the company more. But here's Conagra Brands, trading at a 14 PE. It's had very muted growth over the last, 15 years or so. Its forecast growth is expected to be about 6.5 to 7. So I could get double-digit rates of return investing in this company at these low valuations. It's a market of stocks, not a stock market. I go to my 11th group. Now I'm into like 90 stocks. I've still got PEs in the S&P 500 below 15. I've got names like, Sealed Air Corporation, Smuckers, DaVita, Kraft Heinz, Key Corp, a regional bank and a pretty nice regional bank. Let's take a look at it. I'm just arbitrarily picking these just to point out that just by looking at those metrics, I've identified stocks that give me attractive valuations that I can look at, that I can analyze and do some homework on, and probably find opportunities to make pretty good rates of return going forward. I'm going to go to 12 now. Now I'm into 90 stocks. Now I'm starting to hit the 15 PE ratio, but I've got Ameriprise, I've got Amgen, Borg Warner, which I recently wrote about, Pfizer, which I talked about a minute ago. I've got other financials here. I go into the next group. Now I'm starting to get up to that 15.5 to 16 PE. But I've still got some very excellent stocks here. Some ones, Lockheed Martin with a decent credit rating, Anthem, a pharmaceutical managed healthcare company, that I personally am long in. I think the stock is attractive today. It's certainly investable. I own it at a lower cost basis, thankfully, but it's already starting to rally. But it's not crazy overvalued like the market is. That's the point that I'm trying to make here. I go into my, next group of 10 here, and I've got some Archer Daniel Midlands. I've got Cisco, the tech stock, trading at a 16 multiple with a 6% earnings yield. So I know that this stock is going to be just a minuscule, moderately overvalued, but it's giving me one that I might want to watch and look at. If we get a little pause in the market, I could be able to pick up some shares cheap. I actually did that. I already invested in this stock when it was trading below the blue line here. But once again, these aren't crazy valuations like the market. These valuations make some sense here when you're looking at these stocks. Now, to go on with this, analogy, I go into my 15th stock. Now I've got 150 stocks minus 20. It gives me 130 stocks that are still trading at earnings yields above 6% that I could look at, think about, evaluate, and there's even some good growth stocks there. I can look at a stock like LKQ Corporation, which has been a tremendous growth stock historically and is expected to grow pretty fast going forward. Now, this stock was really inexpensive just, a year or so ago. It's forecast to grow at about 8.5%. The long-term trend line growth, I'm not getting any for it. But this stock is not cheap, but it's not crazy. A little pullback in this stock and I'd be all over it. So the moral of the story here is, even though this market, the market itself, if you were buying the index and buying all 500 stocks at once, I think you would face a lost decade, because these the stocks that are most heavily overvalued are the ones that are, dominating the market. I do want to make that point. So if I go all the way out here, to some of the highest valuation on this, you've got some really crazy. We all know how crazy, Tesla's valuation is. I know there are a lot of people that love Tesla, but you're getting into some really expensive stocks here that have, now, by the way, I want to make a distinction. You look at an Exxon that has a very high multiple. That's because the earnings have fallen dramatically. Okay, if you look at Walt Disney, in contrast, you have a stock whose dividend has been cut. They've actually struggled with, keeping their, they haven't been able to open the Disney worlds and the Disney, and so their earnings have collapsed, but yet their stock is going straight through the roof, and they've eliminated their dividend. There's some crazy stuff going on in the market for sure. And when you dissect the market, there still are well over, as I showed you here in this video, 100 stocks that are reasonably valued, that gives you more than a big enough universe for you to dig into. I'm sure any of you can find stocks within those 140 stocks or so that are reasonably priced, to be able to build a portfolio that will actually not give you a lost decade going forward, but would actually help you make money. Hope you enjoyed this video. Hope it gives you a little better perspective of the market in general and how, the market is made up. But mainly, I hope you get a little better perspective in the reality that it is a market of stocks, and not all stocks are the same, and not all stocks are overvalued. It's a bull market. It's harder to find value today, no question, but it's there if you're willing to look and you know how to look. And those of you who are subscribers, this is the portfolio section of Fast Graphs here with these preloaded portfolios, is a great way. You can go through the same process with the dividend aristocrats if you're a dividend investor. You can go through the same process with the dividend champions and dividend contenders if you're looking for dividends and dividend paying stocks with good growth. Anyway, it's been Chuck Carnevale saying thanks for watching. I hope you enjoyed it. If you did, give me a like, ring the bell, give me a thumbs up. Subscribe to the channel if you haven't already. I appreciate you and look forward to showing you some more of these quality videos going forward here. Thanks for watching.